accelerate people and ideas to tackle agriculture's most important challenges. Our mission is to build trust and understanding where agriculture and society meet. Farm Foundation's Innovation and Education Campus brings that mission to life. Set on a historic 14-acre campus in Libertyville, Illinois, the Innovation and Education Campus is more than a meeting space. It's neutral ground for meaningful dialogue and bold thinking, a space for collaboration where seasoned experts and emerging leaders come together to inspire and drive change. Around the table, voices from across the food and ag value chain convene to listen deeply, plan strategically, and work collectively, turning conversations into connections. Join us at the Innovation Education Campus and be part of the movement shaping food and agriculture for generations to come. Good morning, everyone. Thank you for being with us here today for the Farm Foundation Forum, Risk and Resilience, the Next Chapter for Crop Insurance. I'm Tim Brennan, Vice President of Programs and Strategic Impact here at Farm Foundation, and it's a pleasure to welcome you to today's forum. Thank you all for joining us. A special thank you as well to Farm Credit for their generous support and help making this important conversation possible. But before we get into today's program, I'm going to take just a few minutes to share a bit more about Farm Foundation. We are a 501c3 nonprofit working at the intersection of agriculture and society to address challenges that affect the entire food and ag value chain. Specifically, we're an accelerator for practical solutions of agriculture, accelerating people and ideas into action. The three levers we use to accomplish this are policy, innovation, and education. Forums such as today are just one part of our extensive program of work, which is guided by our mission to build trust and understanding at the intersection of agriculture and society, and a vision to build a future for farmers, our communities, and our world. We rely on partnerships and coalitions to fund our work and increase our impact. So if you're interested in learning more about partnering with us, I encourage you to reach out. One last thing we wanted to share before we got started is that 2 weeks ago, Farm Foundation, in partnership with the Mosaic Company Foundation for Sustainable Food Systems and the PepsiCo Foundation, launched a 3-year cohort program that will equip aspiring and beginning farmers and ranchers with training, mentorship, startup microgrants, and many other tools to help them build a viable, sustainable farm business. For more information on this really exciting new program, please visit farmfoundation.org/farmpath. And thank you again for being part of today's forum. As a reminder, Farm Foundation is a nonprofit. We rely on the generosity of people and partners like you to keep programs like this thriving. Forums like this, where experts and stakeholders across agriculture share the latest insights and solutions, are possible only because of that support. If you're inspired by what you hear today, I invite you to make a gift to help us continue offering events like this at no cost to participants. Our team will post a secure link in the chat, and you can also visit farmfoundation.org and click the Donate Now button at the top of the page. Every contribution of any size directly fuels our ability to bring people together and advance practical solutions in agriculture. Thank you for considering a gift and for being part of this important work. Farm Foundation shares a lot of what's happening in our work and across the sector on our social media pages. Please check us out in spaces like LinkedIn and Facebook to stay up to date on our work. Before we start today's forum, I've got a last few housekeeping notes. There will be an audience Q&A session at the end of this meeting. We'll use the Q&A button at the bottom of your screen, but not the chat, to queue questions. This forum is being recorded and will be posted on our website at farmfoundation.org, as well as on our YouTube channel, and we'll send you a link of that following today's program. Now let's turn to our forum. It's my pleasure to introduce to you our moderator. Keith Coble is the 2025 Farm Foundation R.J. Hildreth Public Policy Award recipient and a Farm Foundation Roundtable Fellow. Keith serves as Vice President of the Division of Agriculture, Forestry, and Veterinary Medicine at Mississippi State University. He's published over 95 journal articles covering risk management, farm policy, and agricultural data analytics. Keith also served as the chief economist for the U.S. Senate Agriculture Committee. Throughout his distinguished career, he's received numerous awards for research, teaching, and service, and remains deeply committed to advancing agriculture through leadership and innovation. Welcome, Keith. It's all yours.
Thank you. It's a pleasure to be here today and be part of this discussion. We look forward to this dialogue regarding crop insurance, risk management in general, and how all that plays a role in the Farm Bill. I think we've got an outstanding panel that is going to speak to us today. And so ultimately, I would like to introduce the panel one at a time. And I want to begin with Tara. Tara Smith has been working in crop insurance for about as long as I have, and certainly works with the Tory Advisory Group. And I'll let Tara tell a little bit about herself.
Good morning, everybody. Thanks so much for having me this morning. Yeah, I'm a farm kid from Illinois. Originally grew up on a corn and bean farm, but have 28 years in DC now, and all the gray hairs to show for it. I've spent about 15 to 20 of that really neck deep in crop insurance, including spending time working for Pat Roberts on Senate Ag Committee, who I think a lot of folks consider, myself included, the grandfather of the crop insurance program. And then have spent the last 12 years here at Tory Advisory Group working with crop insurance companies and the reinsurance community that really gives them their financial backing. Keith, did you want me to talk a little bit more on background on the firm, or you just want to do intros first and we go from there?
Let's do intros first, and next, let's turn to who was John Coleman. And John, would you like to introduce yourself and your background? John is from Munich Re, and that I know a lot of people have heard of the various Re companies, but can you explain a little bit about what that means?
Yeah, absolutely. And yeah, so the NA is North America there on my title, not applicable. So hopefully I'm a little more relevant to this call. So yeah, so I've been in this industry. I'll explain a little bit more as we get into kind of the what we're bringing to the table a little bit later on. But just as far as background, so I've been in our industry, the parametric industry, for about 13 years now, and I even see some names on the call. Hi Marva, hi Jeff Donahoe. It's good to see you guys. See a few familiar faces there in the queue, but I work for Munich Re. Re is just reinsurance. It's essentially insurance for insurers. And so how Munich Re, which is one of the world's leading reinsurers, is supporting the U.S. crop insurance system is by reinsuring the federal crop insurance program. So we have a few key crop insurance companies, names you would probably know, that we support, and so that's how Munich Re supports the U.S. Farming system. I actually work in a very specialized division that is not the division I work in. It's not traditional crop reinsurance, but I actually work in a very specialized group that's offering parametric covers. So in addition to standardized crop reinsurance, what my group does inside Munich Re is we actually offer stuff outside of the traditional governmental programs, i.e. private products that can basically fill gaps and exclusions in federal crop insurance. And so some of the names that I recognize in the attendees are folks I've worked with in the past, basically using parametric products to address those gaps and exclusions. And as I'll talk about a little bit later on, we're not only working, with individual farmers, but all the way across the ag value chain. Investors, milling companies, crush plants, ethanol, cooperatives, grain elevators, and the list goes on of all these different players across the ag value chain who are exposed to weather, to crop yield, crop production losses, and that's really where parametric products fit in. So I certainly appreciate the opportunity to be on here today, and I'm looking forward to a fascinating discussion. Thank you.
Okay, thank you, John. And we can see our third participant is in his tractor harvesting or combine harvesting. So Rick, would you like to introduce yourself?
Yes, I'm honored to be here. Thank you. I hope this is okay that I'm running here. Yeah, I'm a fifth generation farmer from West Central Indiana, and we've been on this journey. I would call regenerative journey for about 16 or 17 years, and we've been doing it before it was even named what it is today. I'm sure it'll change names again. We have worked very hard to be conservation-minded, good stewards of the land, and we care deeply about human health and soil health. So that's kind of what has led my journey here, and actually what started the journey was an erosion event. And I know this may not seem like much of anything to do with the topic today, but it'll all come together here. The erosion event created an opportunity for our farm to start looking at other ways to farm. And that's the message that I try to send out to the people when I'm out talking in public. Change is good. We have to understand how to start to make change, and more importantly, we have to understand that we may need someone to teach us to help us to make that change effective. So as a result of changing our farm, I have been highly motivated to reduce inputs. And as a result, I have not carried any multi-peril crop insurance since 2019. There's no need. There's no need to have it. But you got to understand that you don't listen to a forum like this today and hear the speakers talk and then go out tomorrow and just take everything away. It doesn't work like that. We have taken great strides in what we've done. We've implemented a full-blown, high diverse cover crop system. We have tried to do this with no-till. We're certified organic. We're certified regenerative. We have taken our farm on a vertical integration that is necessary. If you don't know what the principles of soil health are, please look those up when this is over. And one of them is diversity. And I don't care what you do. I don't care if you're a farmer. I don't care if you're an accountant. I don't care if you're an insurance broker. You need diversity in your life. You need diversity in your business. And when you become diverse, you then can start to take away things that don't seem to much matter anymore. So when you look at our farm on the size that it is, right now we're saving a little over $2 million a year in input costs. We have not used any synthetic fertilizers in 11 years now. Like I said, I've taken insurance away. I don't cover, I don't take multi-peril. I don't take wind and hail. I don't take anything. And some people might look at that and say, boy, you're being very risky. You're being, not caring for your livelihood. Well, when you start your system with that much head start, and I feel so confident in our system that we no longer need the insurance. So that's where I am today. Now, I'm sure we'll go many directions here today, but unfortunately, or fortunately, however you want to look at it, I believe a lot of lending institutions require a multi-peril insurance package to go along with the mortgage or with the line of credit. And usually that is something that the producer cannot overcome. They have to do what the bank wants, and I understand that. And again, I've never asked anyone to farm the way we do. All I've asked is please consider to make a change, and please consider to reduce input. That's all I've ever asked. Thank you.
Okay. All right, let's go back around, and I'd like to let each person make a bit of an opening presentation. Tara, you've been around to see how we've gotten to where we are today. What are some of the successes of crop insurance and what are some of the challenges that you see today? And anywhere else you want to go?
Sure. So I think that this is actually important to kind of tee up the conversation around crop insurance, because I think a lot of times when we talk about crop insurance, folks want to talk about, well, we need to improve here, or, oh, we need to improve there. This doesn't work quite the way we want it to. And I think those are absolutely wonderful conversations to have, and I'm sure we're going to get into some of those things during this discussion, especially after the great tee up from Rick. But I do think it's important to put those kinds of conversations in some context first. So I think one point of context is that it's important to remember that crop insurance covers more acres and more types of crops in all 50 states than any other USDA program. More than any conservation program, more than Title I farm programs. It is really the broadest program used by the most farmers that we have. So just in terms of numbers, $159 billion in liabilities are covered right now across 562 million acres of farm, pasture, and rangeland in the United States. Add on top of that, then another 40 billion in livestock policy liability. And compare that a little bit to what we've seen the last few years. So just a decade ago. So go back to 2015, we were only covering 102 billion in crop liability and 295 million acres. Livestock business was really nothing at all. There was a cap in place of $20 million in liability per year until 2018. So we've seen a program that not only is sort of instrumental and fundamental and woven into the daily life of most farmers, but we've seen this program really grow over the years. We cover more than 125 crops now with individual policies. Plus we have, of course, a whole farm policy for those commodities that don't have an actual individual policy. And we've seen that specialty crop business that's so important. We've seen that grow. We went from $17 billion in liability a decade ago to $25 billion in specialty crop liability today. So 40% increase in just a decade. And I think part of the reason for that growth is really the second thing that I think is important to keep in mind with crop insurance, and that's that it is designed to be flexible. It's been built into the program in a way that we don't see with any other sort of risk management tool provided by the government. So what does that flexibility mean? It means that we can do a lot. We can change a lot within the crop insurance program from year to year. Whether it be through the development of new policies through 508H, whether it's just tweaking policies from one season to the next season. We can do all of that administratively without a farm bill, which when you think about where we are in a farm bill right now, that's probably a really good thing. So unlike conservation programs, Title I farm programs, where you have to have legislation in order to make changes to adjust for the situation on the ground, you don't have to have that in crop insurance, which is really, I think, allowed the program to flourish and cover more growers and help more growers and than we saw a decade ago. Now, of course, despite all of those wonderful things, I do think it's also important to keep in mind that crop insurance is just one risk management tool that's available to farmers. Per Rick's point, crop insurance is not a silver bullet. It's not going to solve every problem that ails farmers. And I think every time we look to add to crop insurance, it's really important to ask the question, is this a risk that crop insurance should cover? Or is this something that's being handled elsewhere? We have derivative markets, irrigation, diversification, conservation practices that all can also help a farmer manage risk. And so I think that that's a really important part of this discussion as we talk about what should be changed in the program or what could make the program even better. So I love talking about crop insurance and brainstorming about the future of the program. Really looking forward to the discussion, but I'll stop rambling with that and kick it over to the next speaker.
Okay. Very good. John?
Yeah, Morgan, are you gonna this is the point in the presentation where we do the death by PowerPoint. I think Morgan was making me kind of flip up a couple slides I had. Yeah, so I thought it was interesting, and Tara, great segue. So I mean, I thought it was interesting that just the growth in the liabilities. I was actually looking at this. So as I said earlier, I work inside a specialized division inside Munich Re, and I've been doing what I've been doing for 13 years, and I actually got my start back in 2012 in what you might call the parametric risk transfer market. You might call them index insurance, index products. There's a lot of sort of synonymous terms, but if you're looking at this through the lens of the multi-peril crop insurance program in the US, these would be programs like the rainfall index, the HIP wind endorsement, and the ECO or the SEO coverages, where basically, you know, the payment is solely and exclusively determined according to some index, and the index determines the payout, not the on-farm yields. And so in our industry, we call that parametric risk transfer. And so some of the value that, you know, I've seen our industry bring to the US agricultural system over the years is, you know, with crop insurance, the you know, hyper customization gets challenging, especially from a year-to-year basis. Many lamentations, I think, with the crop insurance program is certainly that it's not a one-size-fits-all solution, and I certainly don't think you can ever get there just with the scope and the variety of agricultural operations we see across our country. But what I think has been really interesting in the 13 years that I've been in this business, and I really started in 2012, we were actually working with crop insurance companies to try and address gaps and exclusions in federal crop insurance using what essentially were at the time weather derivatives. Is actually looking at, you know, year-to-year opportunities for farmers or farming operations, and not just farmers, but the full range of participants across the ag value chain to really address those gaps and exclusions. Either you're completely ineligible for the governmental scheme, or you're eligible for the governmental scheme, but it doesn't protect the entirety of your risk. So, for example, I have a very large farming operation up in central South Dakota who, you know, this year had, you know, after a really dry spring, was looking at, you know, potentially record crop after a really wet May, June. And unfortunately, the crop was maturing much more slowly than needed, and they were actually interested in looking at a frost cover. So that's something that, you know, had there been an early frost, probably would have eroded most of the top end yield. That was really the profit bushels. Crop insurance can't protect or didn't protect those profit bushels. And, you know, this frost cover was probably a year-to-year need that obviously a crop insurance program, you know, hinging on legislation would not have been very responsive to that need, which was probably a, you know, 1 in 3, 1 in 5 year type need. You know, we were able to basically step in and provide a frost cover to this farming operation to basically protect those top end profit bushels, really, which, you know, had that early frost occurred, would have basically eroded all of this farmer's profit for this year. So that's really what we're trying to do with these programs. And if Morgan, you want to flip to the next slide, we're actually able to just leverage, you know, what is vast universes of weather data, climatic data, crop yield and crop production data to actually deliver these programs. So just like the rainfall index or the HIP wind endorsement, those types of programs are just leveraging data to actually solely and independently determine the payout. That's exactly what we're doing as an industry. And so in addition to working with farmers, and I think this is one of the, you know, hidden opportunities, is really protecting the full range of the ag value chain, especially the cooperatives. So we have a few very large cooperative customers where, you know, really those cooperatives, they're exposed to the same risk as their farmers, except they're ineligible for the governmental scheme. And in fact, many farmers are dependent on the dividends that they're paid by that cooperative system. And if the cooperative has a bad year, it's likely that the farmers have a bad year and everybody's having a bad year. And we've actually been able to step in and provide a private solution to actually ensure what you might say is the cooperative's yield or the cooperative's production, to make sure that that cooperative can still operate into the future. So it's super interesting to be able to, to sit in a position now that I've sat in for, 13 years, and to be able to see all these opportunities across the ag value chain to address, needs not met by governmental schemes, or, for those groups who are just simply ineligible. So thank you for the time, and that's my introduction. I'll pass it over to the next speaker.
Hey, Rick.
Yes, sir. All right. If I may be allowed, can I ask John a quick question?
Sure.
Hey, John, do you have to be in a farm program or signed up for multi-peril insurance to get all of those extra add-on insurance policies you were talking about?
Short answer, no.
Okay. All right. Very good. We'll probably come back to that later. I was just curious. Okay. Yeah. I've already kind of started in on where we've been. One of the challenges that farms like what we have to deal with are the rules and the regulations that RMA has brought down. And I have to admit, RMA has moved a lot. But when we started this journey, there was no account for a cover crop. It was looked at as a weed. You cannot cover those acres if you plant a cover crop, and it's like everything else. It's like the carbon markets or whatever. The early adopters or the people who are out at the forefront are the ones who can't participate. I can't think of the word now. I just lost it for the carbon market, additionality. So, but now I've been removed from this market for a long time, so I don't know what all the rules and the regulations are today, but I do know that one of the practices that RMA now recognizes is when the folks want to plant like wheat in the fall, and then they'll come in the spring and they'll plant soybeans in between the wheat, and they are not being discounted, and they can still have crop insurance for that practice. So again, I'm not familiar. Tara and John can sure help us out on how far RMA has come. But when I look at the risk management aspect of it, I'm sure there's a lot of programs that I'm leaving on the table that I haven't even looked at. And shame on me, I probably should be looking at some of them. And it's not that I'm against any of this. It's just that I am the type of person that when I go out in public and I speak and I'm trying to show the audience what we're doing, and I'm trying to explain to the audience how we've taken a lot of these inputs away, if not all of them. I don't want to have my hand out for a subsidy payment to finance the multi-peril crop insurance. That's me. That's how I look at this. It's not for everybody. I think if you are in a situation today where I'm afraid a lot of farmers are in a very high risk environment right now, I believe they need to try to maximize all the tools that are available for them that are current. I mean, I'm sure I'm going to hear of a lot of tools coming in the next hour that I'm totally unaware of. So please don't look at me as a naysayer, and I don't think this is good stuff. That's quite the opposite. I think it's very worthwhile, and I think it's very important to have a risk diversion plan in place, whatever that may be. Thank you.
Okay. All right. want to encourage everyone to put questions in the Q&A. If you have those, please go ahead. Let me kick this off. I want to go back to Tara. And you talked about the 508H and the 522 system. Could you explain to the audience what that is and how it works, so that they can understand what you were talking about earlier?
Sure, I'll give the 30,000-foot view. Basically, it's a system whereby private sector developers or farm organizations or others in the ag sector can bring forward ideas for new crop insurance policies and work with RMA and the Federal Crop Insurance Corporation Board to get new types of policies approved. So if you are a specialty crop producer who doesn't have an individual policy right now, you, through your maybe trade association in conjunction with a product developer, can work on the development of a policy that would be just for your type of grower. And you can work that through the system in order to get that policy approved. Does that sort of hit the highlights, Keith, and at the 30,000-foot level without getting into all the crazy weeds?
And there's a lot of products that are out there now that came through that system.
Mm-hmm. Big products. I mean, you think about dairy, you think about livestock, plus a whole host of specialty crops have all come through that 508H process. So it hasn't been all of the growth that we've seen in the program, but it's been a lot of the growth that we've seen in the program. And that was part of, the design. That was by design. This is part of that flexibility that I mentioned to make sure that the program can kind of grow. And if I can go back to something Rick said on conservation practices, I think that's another way that the program's been able to evolve to meet the needs of farmers. I think it took a while. The system never moves as quick as folks want it to move. But I think we've seen more and more recognition of conservation practices as acceptable within the policies, without having to require necessarily legislation, but just happening naturally through input and feedback from farmers. So,
okay. We have a question that has just come in, talking about regional loss ratio disparities between the Midwest versus Southern crops. Who on the panel would like to tackle that one?
that didn't take nearly as long to come up as I thought it would. Rick, you came off mute. I'm going to let you handle it first if you've got a...
What was the question? I'm sorry, I didn't get it. What was the question?
The regional differences in loss ratio disparities between Midwest and Southern crops.
Yeah, I don't want to be the only one to answer this, but I think this is important. I think we can kind of wrap up a lot of things under the same umbrella here today. Not only just talking about insurance, I think we can talk about farming practices, regenerative practices, regenerative concepts. This all has to do, I think, with context, and I think the multi-peril insurance, or let's just use insurance in general. I think those programs should be regional in nature. I think they should be. I think the U.S. could be divided into 9 regions, and I think you could create rules and regulations within that region that apply to the farmers within that context. I think that makes way more sense than trying to throw a blanket over the whole industry and saying we're going to have these programs. And maybe I missed the boat here, guys, Tara. Maybe it's already built like this today. But I think this is a great question. I think we have to start looking at things in a little smaller compartments versus the whole United States as a whole. I'll stop right there.
Tara, you want to jump in?
Sure. So, this has definitely become a controversial subject because I think by and large, we've seen Midwestern states with significantly lower loss ratios if you look over a decade or longer than a lot of not just Southern states, but even some Western states, to be honest with you, who have had loss ratios consistently over 1.0. And it has created a bit of a tug and a pull and a little bit of a regional issue. If you ask RMA about it, they'll say, hey, our program's still actuarially sound. We are rating the program to 0.88. It just so happens that within that, if you just look at a decade's worth of data, there appear to be winners and losers. So a worthwhile conversation to have, but maybe what would be helpful is I can talk a little bit about the tension points that it's created. I think it's led to maybe some unintended consequences because of these disparities. One of those has been the ability to get reinsurance. I think that a lot of crop insurance companies are finding it more and more difficult to get reinsurance on policies that the private sector doesn't deem actuarially sound, that they don't think the actuarials are correct on, whether that's by a policy type, whether that's by state. It suddenly has become very difficult to get that reinsurance at all, and or has become very, very expensive to get. That, of course, drives down profitability for the crop insurance companies and creates a lot of other financial strains throughout the system. And in some cases, it has led to decreasing agent compensation in those areas where loss ratios have been particularly high, and crop insurance companies feel a lot of strain and are attempting to find ways to get back to profitability in those areas. Keep in mind that this isn't car insurance, right? This isn't Geico. You can't call 15 minutes saves you 15% here. The rates are set by the federal government. And so a normal insurance company would just raise rates in those areas. Crop insurance companies don't have the ability to do that. So it leaves them struggling to find other ways to deal with those sort of hot spots or problem areas. Aside from agent compensation, one other solution that we've seen, which I think is even more problematic for the system as a whole, is we've seen companies just pull out of states. States where they just don't think that they can be profitable anymore. They just pull out. And that means fewer and fewer company options for farmers on the ground. But at the same time, you can't ask private sector capital to go into a state where they don't feel confident that the ratings are right or where money can be made. And so this is a really tough discussion that I think is happening in the countryside right now. And it's a discussion with RMA, with crop insurance companies, agents, farmers, everybody is being impacted, unfortunately, and some good weather in places like Texas would sure as heck help, but I think it's going to continue to be a point of discussion.
John, did you want to weigh in on this one, or?
I mean, yeah, play kind of devil's advocate here, and the way the light's coming in behind me, it looks like I'm an anonymous witness. So maybe for the things I'm about to say, it should stay that way. But yeah, I mean, I think that is the challenge, right? Is like, you do have kind of like this umbrella approach through one, rate making body, and I'm just looking at this from a private sector perspective. Is like, I talked about the first 7 years I was in our business, trying to address, and this was actually working at a company that was actually ideated as a 508. In fact, Watson Associates was the one who developed it, and then it was eventually privatized. And so the challenge in those days, of course, is like we're going to farmers with what the private market believed was a fair premium, and the farmers are just sticker shocked to death because for the most part they haven't seen the 60, 70, 80% bite that's been taken out by the federal government. And even then, it's like it might still be improperly rated, because, when you're looking at, let's say, rating a West Texas precipitation risk, you're looking at solely and exclusively rating that risk, versus you don't really have money to pull from, like, let's say in central Iowa, where you can sort of funnel money around to basically compensate or cushion, some of these other areas, which, then the guys in Iowa and Illinois might start to say, well, hey, like, we've been paying into crop insurance for years. We've never collected a thing. And then you have guys in West Texas who are basically trying to plant dryland cotton into a drought, hoping it doesn't make, because it's more profitable to collect the crop insurance than it is to collect the crop. And these are, some of the, I think, kind of perverse incentive schemes that can start to develop. And everybody kind of looks at their own situation and says, well, what's best for me?
Okay. Let me, a question that came in early, and let me just read it. How can crop insurance programs evolve to better support smallholder farmers in regions facing compounds risks such as climate change, market volatility, and limited access to financial services? So, would anybody like to tackle the small farmer question?
I can make an attempt at this one. So we hear this occasionally, that, I'm too small. Nobody wants to sell me crop insurance. I would just say to that, and honestly, you can make my email available. Shoot me a note. We'll find you an agent who will sell you a policy. If you want to purchase a policy, that should not be a hurdle. And I think we're more than happy to help you. USDA, I think, has made some great strides in the last couple of years in making sure that resources are available to folks to try to find an agent, hook them up with an agent. But we don't want anybody who wants to buy crop insurance to go without. Now, having said that, I mentioned earlier that crop insurance isn't a silver bullet, and crop insurance still isn't going to be a silver bullet, right? It still may not solve every single problem that you're facing on your farm. It may require a combination of risk management tools in order to address all of those concerns. It may require some conservation practices, it may require derivatives markets, and it may require a crop insurance policy. And so I don't want to oversell that crop insurance is going to be that silver bullet. But again, if there is a smallholder farmer that wants to buy a policy, let me know. We will find you an agent.
Okay. Other comments? Well, let me move on then. What role can public-private partnerships play in enhancing the adaptability and scalability of crop insurance to meet the future of ag challenges? Well, we've got a strong public-private partnership occurring with the private companies who deliver the insurance and the USDA, which subsidizes and backstops and reinsures these policies. Tara, again, I'll pick on you to begin with, but can you kind of describe how the roles are defined between the current situation between private companies and RMA? You've already alluded to it, but can you?
Yeah. No, I'll take a stab at this and recognize that, quite frankly, it's this public-private partnership that means that crop insurance is still functioning during this, what are we on, 28-day government shutdown. So while we've seen a lot of hiccups on FSA programs and other monies not going out the door, farmers are all still getting their crop insurance payments because we have this public-private partnership. So essentially what happens is you have a private agent that contracts with an AIP, that's an approved insurance provider, that's your crop insurance company, to write the policy. So the private sector company takes on actual policy. They're your Geico, they're your Liberty Mutual, and they work with an agent to actually be the face of that policy with a farmer on the ground and be that first step of customer service, if you will, to sort of walk farmers through what the policy options are, which ones might be best for them, what the pricing structure would look like. And then private sector companies also have adjusters on the back end that come out and determine if there was a loss, if that's required. Of course, if you have one of John's parametric policies, you don't have to worry about that kind of stuff. And then crop insurance companies at the end of the day are going to make that payment to farmers. What do companies not do? We don't set the rates. Again, we're not the actual agent on the ground with the farmers, and we're not the actual adjuster on the ground in the farmers, but we're taking on the risk of that $154 billion through using our own capital, through using some government reinsurance, and then through going to folks like Munich Re to find private insurance. Does that help? Did I make it more confusing?
John
Okay.
or Rick, do you want to add anything to that?
Go ahead. No, I do not. No, that was very good.
Yeah, well done, Tara.
I have a question. What is the best way to encourage farmers who want to try a new crop, especially not something that is commonly grown in their area, to be able to attain a workable crop insurance policy? So in one sense, what if you don't have a history of producing this crop?
And this is one I can confidently, I think, take a stab at.
Okay.
It's gonna sound like a sales pitch, and it probably is. But I mean, I think this is the advantage of parametric risk transfer. I mean, to the question Rick asked before, it's like, with parametric, I mean, the beauty is like you don't have to care, right? I mean, you look at like the rainfall index, the PRF program, annual forage. I mean, those are all basically the payouts are based on the amount of rainfall or the amount of precipitation in the grids during the time frames. I mean, that's basically it. Now there are some tacits there around like, ownership of actual, grazing land and so on, but that's because of the way it's being delivered. Really, the core mechanics are just payouts based on the level of precipitation. So when you have something like, transitional acres moving to organics, for example, or moving to a new cropping practice, I think this is some of the challenge that farmers are probably seeing is like, I don't want to switch away from a revenue-based guarantee that I've had on my corn and soybean rotation for the last 20 years. So with parametric risk transfer, we don't have to care. It's just a predefined weather variable. And so if transitioning to whatever crop exposes you just purely and the predominant risk is frost, excess rainfall, drought, what have you, the parametric product doesn't really care. All it cares about is what's the weather risk, and if the weather event happens, the product pays regardless of what's grown underneath. And so it sort of takes this agnostic look at risk. It doesn't have to care per se what's actually growing on the ground.
Okay. Other thoughts and comments?
I know that this has been a frustration for a lot of folks, kind of trying to diversify their operations. But I would be remiss if I didn't take the opportunity to say that, one of the fundamental cornerstones of the crop insurance program is this actuarial soundness that we talked about a little bit earlier. And that makes it really hard to create an actuarially sound program for a commodity for which you have no experience. You kind of have to have the experience to create the actuarial tables. And so I think some short-term solutions like what John was talking about probably are going to be necessary. I know we've talked to several groups who have looked at some sort of other private insurance policies to get them through those first couple of years before they're able to purchase a policy that's got that federal crop insurance discount associated with it.
John, I've got a question here that's directed at you. Could you explain index insurance?
Oh yeah, sure. Um, yeah, let's see. So when we say index insurance, and in our industry, you might have heard these terms. So they can be called, weather derivatives. They can be called climate derivatives, index insurance, index products, parametric insurance, or just parametric products. And basically, the parametric is the overarching term. The parameter determines the payout. So if you go back to my slide, and it may not be handy or may not be up, but if you remember what was on the slide, it's basically this vast universe of weather data, climatic data, natural catastrophe data, which has been produced for, potentially centuries in some locations, where this is all information being reported for informational purposes. And essentially, we're just using that as the source of truth in determining the payout. So, very simple example, right? Like, so I gave the West Texas cotton producer example, right? The West Texas cotton producer says, look, if I plant this cotton, we're already in a drought. If I plant this cotton and it doesn't make, I'm standing to lose $100 to the acre. Well, we would just design a precipitation index that would say, hey, if the amount of rainfall over the summer is less than 6 inches, this is going to pay you $20 per lost inch of rainfall up to a maximum of $100 per acre. And so the product doesn't care per se that it's cotton. It doesn't care what the farmer has invested. It doesn't care about the APH per se. All that matters at the end of the season is what was that chosen trigger for the precipitation level, and where did the actual precipitation level come in. If it's at or above the trigger, no payout. If it's below the trigger, there's a payout. That's the only thing that matters in the outcome of that product. And so it really kind of, you might juxtapose it against your traditional insurance, where it's like, hey, if you have a car crash, like, you're going to basically send the car to an auto body shop. They're going to inspect the actual loss, like, i.e., what damage happened to the car, and the idea is they're going to make you whole before the loss actually happened, i.e., what was the state the car was in before you had the accident. And that's based on this principle of indemnity, right? Making whole. Well, in the index world, the farmer could have actually lost $200 per acre, not $100 per acre, but all the precipitation product is going to do is cover that $100 regardless of the actual loss of the farmer. So, the prior question I answered about, hey, we're trying to transition to new crops. Crop insurance doesn't protect those gap years or those bridge years until we're up to full production that well. Index insurance can come in and basically look at it agnostically, because all the index insurance is really looking at is, what's the frequency and likelihood of the weather event or the climate event. It doesn't really care that it's even agriculture, for example. It just cares about, what's the frequency or the likelihood of the event. So that might have been a long-winded answer, but I hope, there's a lot of misnomers, or, like, I think those industry synonyms, especially like the weather derivatives, the climate derivatives, parametric insurance, parametric products. I mean, I think that just gets a little confusing, because I would say, like, as our industry, we've used a lot of confusing terminology. I also think that these products have been, based on industry application, have been the most misapplied to agriculture, because agriculture has not been well understood by the parametric industry. And, I hope to be at least an expert at this stage of having done this for 13 years, and hopefully to be clarifying maybe some misconceptions and confusion. So thank you for that question.
One of the things that I'll throw out is that we actually, when I began working on crop insurance, it was kind of either or. are you buying an individual level coverage policy, or are you buying an index product? Now we see a lot of mixing of the two, and policy has kind of driven us that way. Tara, would you speak to the kind of the layering of different layers of an individual coverage and an index product?
Yeah, so I think there was a recognition that some producers in some parts of the country cannot afford buy-up coverage at that 80-85% coverage level. That maybe, our farm in Illinois is perfectly capable of purchasing because it's very affordable. That's not the case everywhere. And so I think what we've seen in the past is we've seen this coverage gap where you have farmers who just aren't able to purchase up to the levels of insurance that they'd like to purchase up, and that can drive the need for ad hoc disaster assistance. So the idea really is are there some parametric products that you can layer on top to essentially provide additional coverage to those farmers in those regions that isn't this multi-peril crop insurance, but gives them a little bit more coverage than what they're able to afford otherwise. So that's where we've seen things like the hurricane insurance policy have come into effect and be used very effectively. I think, one of the questions that it does raise is, when do we get to a point where we are starting to, with all of the bells and the whistles and the add-ons and this and that and the other, when do we reach a point where we're over-insuring farmers? Is our goal to make a farmer whole? What's sort of the goal of policies writ large, in combination with recognizing that you have Title I as well? And so I think as the program has progressed over the years, that's one of the questions that I think gets raised, not just by parametric policies, by the way, but by all of the other add-ons that we've seen, whether it's trend yields or whether it's yield exclusions. At what point are we insuring farmers to a degree that they're gonna get a payout every year?
Yeah, hey, Keith, can I throw something in here, please?
Sure.
Yeah, I mean, these are excellent points. You guys are awesome. We have to make sure that we don't give the industry a black eye just because of a lot of the things that I've just heard. I mean, I don't know what the exact dates are, but let's just use some numbers here. So in Indiana, that's where I'm from. Let's say our starting plant date for corn is April the 15th. Okay. And if I understand the insurance correctly, and if you start planting before April 15th, you're not going to be covered on those acres. I think that's correct. But now for, I think, $1, you can back this thing up into March now. So how much sense does it make to plant corn in Indiana in March? This is the types of events that have to stop, because it just promotes poor farming practice, plain and simple. So we gotta think and Tara made an excellent point. Are we over-insuring the farmer? I would have to say yes. In some instances we are. So we got to be careful, and we got to make sure that we're using these tools properly. I mean, I don't think this would ever happen, but I suppose one day they could go away. They could just disappear, and everyone has to stand on their own. Imagine that. But anyway, yeah, I just wanted to throw that in. We kind of got to be careful here of some of these rule changes that have come in here in the last few years.
Okay. One of the questions, so we've had a respondent that is referring to John's Texas grower planting cotton to collect a loss. One thing, we're having this while the government shut down. If we had somebody from RMA here. I am, so I will say what I think they would likely say, and that is that their rating system looks at the losses within a state for a crop, and that they don't cross boundaries with that. Now, that does not mean if you take a short sample, and by short, I mean less than 20 years, that you don't see differences across regions. But Tara, do you want to speak to the question of the cotton farmer throwing seed in the ground for cotton?
Yeah, I mean, that farmer probably isn't going to be in business for very long, right? That's something you can maybe get away with for a year. You can maybe get away with it for 2 years, but realistically, that kind of farmer probably isn't going to be around for the long haul. And as frustrating as a lot of the rules and regulations and the paperwork can be, part of why we have all of that, part of why we have data mining in crop insurance is to prevent bad behavior within the system, right? I mean, the crop insurance program runs at one of the lowest, I don't want to say fraud rates, improper payment rates in the entirety of USDA, because we do such a good job of data mining and making sure that farmers are kind of keeping it between the rows, if you will. But I do think, again, you run into this bigger problem of what should we be insuring? At what point are we over insuring or allowing farmers to over insure? And it's a real tug and pull between affordability and wanting farmers to have coverage and not have ad hoc disaster assistance, and also creating a system where you could be potentially overpaying farmers. And so, we've seen just in OB3, the reconciliation package, we saw some increases in premium discounts for various types of policies. We saw an increase in coverage levels for some types of policies. So now you can buy an area-wide policy at 95% coverage with an 85% premium discount. So think about what that means by the time you add on a couple of bells and whistles like trend yield and maybe a yield exclusion here or there. Are we really setting up a system that is recognizing a reasonable yield for that farmer? Or have we set up a system where the expectation is just so much higher than what they're ever going to be able to actually grow on the ground in a year?
Okay.
And I'm not saying this having the answers. I just think that these are the kinds of questions when we start talking about and thinking about policy changes that we have to keep in mind.
Hey, Tara, if I could ask another question, does you just made me think about something. Do the number of claims you have, does that fall into any category as a farm, not as a farm to farm, not across an industry, but a particular farm? If they have so many claims, either in a series of years or in consecutive years, does that factor into anything?
Yes, in some ways. So there are limitations on prevent plant and the number of years you can claim prevent plant, for example.
Yes.
Before you lose your premium discount. There are automatic audit triggers that are in place as well if you have claims over a certain amount. So, there are some safeguards, I guess, that I think are in place wisely for the program.
Thank you. Yes, thank you.
We have a question that asks about what are the leading factors that cause such a large increase the amount of acres or farms that are covered by insurance policies within the last 10, 15 years. What are the producers' motivations? So, Tara, I think you can touch on the growth in livestock is one thing.
Yeah, I think when you look at the growth in acres is really driven by PRF, pasture, rangeland, and forage policies, right? If you look at how many acres of actual crops we grow in the country, it's less than what is covered by crop insurance, and that's because of the pasture, rangeland, and forage policies, which are a parametric policy that just covers rainfall. And then very much the livestock policies. I mean, the exponential growth we've seen on the livestock front has been both wonderful because it's brought a whole new set of farmers under the tent that's crop insurance, but also at the same time, I think has put some strain on the system, just in terms of, again, going back to finding reinsurance, finding a home for all of that additional risk in such a short amount of time.
Okay. I've got a question here that brings up, and I think this touches on the conversation that we've already had. What about, and Rick, you are essentially, it sounds to me like you're self-insuring. So we've got government subsidized insurance being delivered by private sector delivery. We've got private products that are out there that are unsubsidized, and we have self-insurance. And so, Rick, I'd like to kind of pry a little bit more at the question of why do you choose to self-insure?
Yeah, it's a great question. And, you know, like I said earlier, when I first decided to do this, it was because I was standing there in front of people asking them to start taking things away and start standing more on your own and reducing inputs. And I didn't like the notion of a subsidy payment to help pay for that. I don't know what the percentage is. Sarah and John would know. I think it's in the 60-some percentile. Maybe it's less. It doesn't matter. I don't care. But now I guess it's just become a part of my farming life. I don't need it. I you know, again, I don't play by the rules that are laid out. I probably can't be insured on a lot of things. I could probably be insured for a whole farm, maybe. I've never looked into it. But again, I've been away from this for a long time. I don't know what the rules are now, but I'm not in the bucket that they're going to insure to begin with the radical things that we do. I mean, we plant soybeans into standing cereal rye and wheat and harvest them together. I mean, it's just unheard of. So, but yeah, Keith, I mean, I guess you could look at it as self-insured, even though I don't have any policies. I'm just looking at it as we build soil health and we build more resilience in our system, we are less dependent on getting a subsidy payment on a yield reduction. Let's put it that way. Are we yielding with our neighbors? No way. There's no way. We're organic. We're trying to do this no-till. We have incorporated some tillage now. We're probably going to keep some tillage on the farm for many reasons, and that's not today's discussion. But to really answer your question, Keith, it's just become a part of my life and the way I farm. I don't even think about it. You know, I had a weird thing happen, though. I just want to tell a quick story. This summer, there was a huge storm projected to pound our area. I mean, the weather forecasters were calling for 3 to 4 inches of big rains and driving wind that really would have hurt our crops. And I thought, you know, maybe I need to buy some wind and hail insurance here today. So I call up an agent, and I think I was maybe 2 or 3 days past. Is it June 15th, maybe? Which I don't understand this. You can't buy hail insurance after June 15th. And I said, no, wait a minute. I don't have multi-peril insurance. He said, no, it doesn't matter. It doesn't matter if you don't have multi-peril. You can't buy hail insurance past June 15th. And I'm like, this is nuts, because there's a lot of storms that come after June 15th. So it's just kind of weird how some of the rules and laws have taken a hold here. It's just, sometimes you got to scratch your head and wonder why. And maybe I have the wrong date there. Tara, you can help me, but I thought it was June 15th.
I'm not sure on the
Probably
date on hail insurance. To be honest with you, I know that that's the cutoff for planting date in a good chunk of the Midwest, but I don't know for sure on the hail date. But I will say, Rick, one of the things I really appreciate about this conversation is a lot of times we'll talk to farmers and they'll say, well, I don't buy insurance, and so therefore we shouldn't have it for everybody else. And I just really appreciate the recognition that you're in a different situation. Every single farmer is going to be different. Different regions are going to be different. Just different crops are going to be different. And it's just not a one size fits all.
Yeah, well, thank you for that comment. I greatly appreciate that. And you're exactly right. And Dad told me something a long time ago, and I think it still holds true today. If you look at the United States, every single year, there's at least a 10% of the area of the United States has a growing problem every single year. Now, it's not the same 10%. It moves. This year it was west of us. The really high yielding acres just straight west of us were in a drought most of the summer. So are they going to trigger a payment? They may, because their APHs are probably scary high. I'm talking Champaign County. But yes, this goes back to that context thing. And I don't get into these struggles like you guys do, but I can only imagine when you're sitting down there with a client, Tara or John, and they're like, I didn't have enough yield to pay my bills, but yet I didn't have a low enough yield to trigger a payment. What am I supposed to do here? So it just, sometimes it's darned if you do and darned if you don't type.
Question somebody has put in the chat. We've talked around this. We hear lots of concern about what's going on in the world trade and commodity prices and things like that. So what role does crop insurance play in dealing with a weak farm economy? Anybody want to tackle that one?
I think John officially gets off the hook on this one with the parametric side here. Yeah, crop insurance covers single year decreases in price. It's part of what we can cover in a revenue policy. It does not, however, cover multi-year price declines. That's what we've always kind of looked to Title I farm programs to handle. And so there are limitations there in terms of what crop insurance is going to cover. There's been a little bit more innovation in the crop insurance sector on margin policies to help with increased input costs, which have also been a problem for farmers recently. But there are limited inputs covered. It's not had a huge amount of pickup. So I think there are pieces of a rough farm economy that crop insurance is designed to cover and can cover. But again, it's certainly not going to cover some of the bigger picture issues that we have.
Well, hey, Tara, again, I've been away from this for a while, and I don't mean to try to hijack this conversation. But I got so many questions. Does somebody look at the farming practices that the operation has? What I mean by that is, let's say you wanted to, you've been going to conferences, you've been reading the farm magazines, you're buying into this regenerative notion that, you know what, we can reduce our inputs by 30%. It's not about yield anymore, it's about ROI. Does all that come into play when it comes down to the time of making a payment or not on a claim?
Yeah, so farmers have to follow good farming practices, and those good farming practices evolve. And so the idea is that they should be evolving to take into consideration new conservation practices. Again, that probably doesn't happen as fast as some people would want that to happen. And so that's where there can be a bit of a tension point, is if there's a lot of innovation on the conservation front that's not getting incorporated fast enough into good farming practices. But as long as you're following good farming practices, as they're defined at the beginning of the year, you're in good shape.
So this is coming down through RMA?
Yeah, RMA controls good farming practices at the end of the day.
Okay. All right.
But again, this is one of those things that is very flexible. Like the good farming practices handbook can change from year to year to account for changes in what's actually going on the ground. What we are doing today in agriculture and in terms of good farming practices, it ain't what we were doing in the 80s. So
yeah.
It has to adjust.
Thank you.
Yes. Question that I will pose to you. So what changes would you, if you could wave a wand the next time we pass a farm bill, what's one thing that you would like to change about crop insurance? And I'll pose it to all three of you.
Well, since you're gonna leave it to me, guys, thanks. I just think we need to sit down and go through some of the programs and make sure that the farmer's best interest is in mind here. I'm going to go back to the cotton thing. This happens. I speak quite frequently around the United States, and I hear these stories all the time. They had a program where if you could just get something out there, scattered out there, that would qualify you as planting that crop, and now you're in line for a payment, and guess what? You get a farm again next year. I don't like the notion of farming with the intention of an insurance policy bailing you out. So that I get the insurance policy to be for a catastrophic event, not an event that tries to make your bottom line become profitable. That's what I think needs to change in the rules and the regulations. And I know that's like an armchair quarterback statement. I know that because there's so many things involved to what I just said there. I get it, but we've got to start somewhere. You got, a mile run starts with one step, and that's what we got to do, is get that first step.
Okay. John, thoughts?
Should I tell the truth? If you ask me my private citizen hat, just based on how markets function, we talked about this in the prep call, but I would say if you want to return the profitability to farming, you gotta not subsidize the activity. So the more you subsidize of an activity, the more of it you're going to get. And unfortunately, that's going to reduce the profitability. I mean, basically what the market's telling you right now is you're basically hoping for a drought somewhere else, because when you've got a couple hundred acres of yellow #2 corn in central Illinois, the market's telling you right now you're not producing something that's of value. And the hard line here is like, we've talked about diversification, right? So it's like, how do you get a farmer to diversify when he's on this railroad tracks of having a revenue guarantee for his corn and soybean operation that's been in business for 20 or 30 years? And, to me, it's like, if you want to return the profitability to those acres, you're going to have to get some of the acres out of production, because now you're competing with low cost producers around the world. And how are you going to do that? I think in the US, we can compete very well with time to market because of the infrastructural efficiency that we have. But when you have a global glut of grain and there's really nowhere to go, that infrastructure really doesn't have much value. And so we see this reflected in commodity prices now, where commodity prices are in the toilet. If you're in some of those marginal areas, you're probably basically at your cost, if not slightly below your cost, and you basically worked a whole year to lose a little bit of money. So my short statement would be, cut some of the subsidies back on crop insurance. You'd actually bring the profit back into it for the guys who are aggressively trying to grow an operation for a profit. That would be my short statement, but that's my private citizen hat. If I'm looking at it from the perspective of what can you do with crop insurance today, it's like, go back to the same argument. It's like, are you going to compete with a low cost Brazilian producer over the next 10 to 20 years? Probably not. Where does this probably go? Specialties, organics, things like that. And so how do you make crop insurance more flexible, to the question that was posed before, to essentially bridge these gap years where you're trying to transition to those other crops or other practices that you haven't historically done.
Okay.
Hey, John, thanks for telling the truth. That was awesome.
Tara.
It's a defect of my kind, Rick.
Oh,
I'll talk a little bit about something I would want to look at and think about changing, but then I'd love to go back to John's comment.
Please do. It's going to be a little controversial, otherwise it's not fun for the audience.
So I think one of the things that we've spent some time heading into this Farm Bill really looking at is the 508H program. And innovation in the crop insurance sector is fantastic. It's wonderful, but I wonder if it's really where it should be. It is the idea that we should continue to service policies where you're selling 5 policies a year. Is that a good use of taxpayer dollars? Is that a good use of AIP, crop insurance company dollars? Is that a good use of agent time to have to get trained on this policy that 5 growers are going to buy? What's the cost benefit there look like? How should we actually be rolling out these kinds of 508H policies, these new policies, in a way that's actually going to ensure farmer buy-up of some of these policies? We've seen some rollouts where you're rolling out a policy 6 weeks before sales closing date. Nobody has time to market that product. Nobody has time to train on that product. That's not doing right by our farmers. So I think that there are a lot of things in that 508H process that could be improved. Those policies also don't have to be actuarially sound. At the end of the day, these are privately owned products. And so there's limited control over making tweaks and changes there to those kinds of policies. And it's where we've run into a lot of issues on the reinsurance front. So that would be something I think is worth exploring, whether or not there are some improvements that could be made. Going back to John's comment, I absolutely get the free market rules. We shouldn't be subsidizing anything, all of that good stuff. I will note, and I've had this conversation, this debate, if you will, with a number of my friends that work for sort of far-right free market organizations. And they would talk about crop insurance is horrible, crop insurance isn't free market enough, until we started writing $28, $30 billion a year ad hoc disaster assistance checks. And suddenly crop insurance starts looking pretty darn good. Because at least it's a program where it's driven by markets. It still only works within the parameters of the market price for the year. a farmer still has to pay for that crop insurance policy. It isn't free, like ad hoc disaster assistance, like Title I farm programs, like other assistance that's available out there. And it requires a loss before you're getting a payment, which again isn't always the case with programs that are ad hoc in nature or are decoupled from what farmers are actually growing. So I actually think in the world of different types of assistance that will go to farmers, because this world is political and we will get assistance to farmers in some way, shape, or form. I think within the universe of ways to get assistance to farmers, crop insurance is by far the most market friendly, the most market oriented, and one of the most logical ways to go about doing that. So, for what it's worth.
Let me encourage folks, if you have questions, get them on in to the chat.
But I'd just like to say something, Keith. This has been
Okay.
absolutely incredible. This has been an awesome panel. I sure hope the audience has appreciated this, and I know it's being recorded. This needs to be listened to by everyone. I've learned so much today. Thank you, John. Thank you, Tara. Thank you, Keith. This has just really been very satisfying. I just want to get that out. Thanks.
Okay. I want to, not seeing any more questions, I want to let all three of you have a final comment. So John, would you like to kind of, what are your thoughts at this point?
Including thoughts. I would say just from our lens, if you are experiencing challenges with the crop insurance system, especially as we hear more of these discussions around regen ag practices and transitions to organics or diversification, I would just be interested to hear back from folks who are on this call what challenges you're seeing, and then maybe from a parametric lens, maybe how we could help you address those. I think that's just always very, very interesting.
Okay. Thank you. Tara, you want to have the final say?
Final say, Rick, are you up?
I don't care. If you're going to close this out, I'll go ahead and go. I'll go right now.
Okay.
Yeah, I mean, again, we're in an environment that I don't think a lot of, especially a farmer that's 35 years, maybe even 40 years old or younger, has ever experienced. Okay, this is new territory. We're down here at really low prices with the inputs they're using aren't at record highs, but they're pretty high. They're higher than they should be in relationship to where the price of corn and beans are. So it's all about saving the livelihood of your farm. You have to be able to save the farm, not only for tomorrow, for next week, but for the next generations coming behind you. So if that requires a multi-peril crop insurance package, so be it. If that requires a hail package, so be it. I just think, again, some of the rules and regulations need a little more tweaking. Try to make them a little more validity so that they're not being exposed and people taking advantage of the situation. If we can clean some of that static up, I don't see any reason why an insurance package is not part of your risk aversion package. I think those go together. So please don't look at I don't think I'm being reckless, but I'm being a little stubborn. So please don't look at my stubbornness of not taking multi-peril insurance, meaning that you never should take multi-peril. That's not what I'm saying. So use all the tools you have and take advantage of every situation you can. And again, this has been a great learning experience for me. Thank you guys. I really appreciate for being on here. Thank you so much.
Okay, thank you, Rick. Tara, take us home.
Yeah, I don't know if I have any profound comments other than this has been a really great conversation. And these are the kinds of conversations that I think policymakers need to be having more and more in DC, but are often these days, unfortunately, kind of overshadowed by other issues and other discussions. But I think this sort of introspective look at a program like crop insurance and what's working and what's not working and how it can serve more farmers, but do it within the parameters of the program and do it smartly and wisely is just a really useful conversation for folks to be having. So really appreciate John and Rick's comments today, and our fearless leader, Keith, for keeping us on track as much as possible.
Sherry, would you like to hop in here and you put a comment in the box about struggling farmers and a plug for the Farm Foundation? So would you speak to that real quickly?
Sure. Cold call, Keith. Nice professor job there. Cold calling the pupil in the room. Yes, I put in the chat the Farm Family Wellness Alliance. As we as farmers are finishing our crop season, many of us were looking ahead knowing it was going to be hard. And as we start our plans for 2026, knowing it's going to be hard, if either anyone online here today or anyone you know is struggling, and sometimes you don't even know if they're struggling, please share the Farm Family Wellness Alliance. It is an anonymous farmer-to-farmer network through a platform, and then it has free wraparound services, financial counseling, psychological counseling, stress, all of that. So please share that. We know it's a tough time in farm country, so please share. Thank you.
Okay. Thank you. Tim?
Well, thank you so much, Dr. Coble. I really appreciate it, and appreciate John, Rick, Tara. You were all fantastic. I thought I knew something about crop insurance. Turns out I know absolutely nothing. So I really, as Rick said, I really appreciate this discussion. And I think it really does leave the door open for a lot more discussions like this. Farm Foundation is currently digging in pretty deep around policy and trying to sort of build up some scenarios and ideas around these discussions just like this. So this was super helpful for us, but judging by the audience engagement, it was helpful for a lot of folks. So thank you so much. And the audience, thank you for being here. Thanks for your questions. We really appreciate your engagement with us, and we'd love to hear your feedback. So please take a moment to share your comments on today's session in the brief survey that you're going to get right at the conclusion of this forum. And once again, I'll ask, if you enjoyed today's session, please support our work. Please consider donating to Farm Foundation. There's a link there in the chat. And thank you once again for joining us today. That will conclude today's forum. Bye-bye.